All right, Matt. Well, Lincoln Ellis is Managing Director for the Lynn Group. He's also Chief Investment Officer for the Strategic Financial Group. Lincoln, good to have you back here with Matt and myself. So what are you making over the recent market activity that we're seeing? We're down, 4 weeks in a row here on the S&P?
Yeah, it's pretty impressive, the move to the downside, but as you know, not unexpected to us. Perhaps the pace and rate of that change has been caught us a bit by surprise. But, look, the market is factoring in and has had to deal with the perfect storm, the Bermuda Triangle of bad news, bad debt negotiations, the sort of crumbling consumer and macro data that we've seen, and then, of course, the circus that's going on in Europe. And with all that uncertainty, investors who were sort of precariously perched at very high levels of expectations have obviously adjusted them significantly.
Yeah, I call it our triple play, the worry about the U.S. economy, our U.S. fiscal situation, then Europe. I mean, anything on the horizon, Lincoln, that you think could right this ship, make it a firmer, more comfortable market here? I mean, we had one trader earlier talk about maybe something, some kind of meeting at the New York Fed. We've got Ben Bernanke giving a speech a week from today from Jackson Hole, Wyoming. Are you anticipating anything's going to come out of that, or maybe out of Europe at this point?
Carol, what would be really nice on this Friday as we move into next week is if the adults in the crowd would stand up. And that would mean that the market participants would actually not ask Mr. Dudley or Mr. Bernanke or Mr. Trichet to actually get out and try and, quote, do something. The market is actually dealing with the reality, the mathematical reality of what it looks like when you come out of the backside of a massive contraction like we have. And so stocks are simply pricing themselves for those forward earnings expectations with very weak consumption numbers. And the equations are pretty simple. We cannot continue to have Daddy lead us out of the forest every time.
Although we count on it every time, don't we, Lincoln? Listen to what David Tice told me earlier today about the level he expects on the Dow.
I really think we could fall to the 8,000 or 9,000 level on the Dow. I used to have some levels a lot lower than that. Now we've printed so much money, and there's so much money sloshing around the system that we probably don't fall further than that.
So what do you think about that? I mean, David Tice, Lincoln, usually is forecasting like S&P 400. So to hear him say down 9,000 makes me feel less bad.
Yeah, it makes me feel downright bullish. Look, I think the numbers are 9,500 to us would be sort of a level that we could foresee in the Dow, although we see really 10,000 being the line in the sand there. But as our friend Eric Best at Best Partners tells us, it's not really a kind of environment where history or even technical guides will be of very much use to us. It is very chaotic. I think people are even underestimating the levels of concern that you're seeing both on the consumer level, on the front lines of the private sector, but also with world leaders. A total void of leadership and perhaps, in fact, for markets this time around, that's a good thing.
Hey, it really did feel like there was no place to hide this week. Julie, I want to bring you in because you're looking at the crazy week in stocks. I mean, it was a tough one, down almost 5% here on the S&P.
It was a tough one, even though we saw all that volatility during the week. I've been looking at some of the group performers on the week, and as you would expect, it's the cyclicals that did the worst, those most vulnerable, if indeed the economy is as bad as it seems people are thinking it is at this point. Technology down the worst, as I discussed earlier, an 8% drop for the week. Industrials down 7%, materials down 7% as well, and sort of resisting that plunge, at least to a much better degree, are the defensive. Utilities up 2%, consumer staples little changed, telecom services down about 0.2%. So, Lincoln, given all of that, I mean, given the chaos, what do you do in this environment? I know you're looking at some of these groups that I just mentioned. What's interesting to me is that they're groups that are on opposite ends of the spectrum in terms of recent performance.
That's right. Last time I was on with Matt from New York, we talked about the suit thesis, the staples, utilities, industrials, and technology thesis, that those would be really great places to hide out, and that certainly on a relative performance level, that would be where you would want to be. We've also, in the last 4 or 5 days, actually trimmed our bond position. We've actually sold somewhere in the neighborhood of 15% of those fixed income securities, simply because we're not quite sure that yields really have that much lower to go, and that there are much more attractive things to be looking for in the investment universe than 1.67% on 10-year money, which looks like we may head back and challenge that historical low.
So try to stay still, more or less.
Hey, let me ask you, Lincoln, because I've actually got a viewer writing in, and he says, what is your guest earnings estimates for the S&P 500? And I bring it up because Adam actually talked about earnings estimates at this point. I mean, a lot of folks think they're way too optimistic, considering the street keeps bringing down growth estimates for the rest of this year and into 2012. Where are you, though, when it comes to the S&P value here?
So, as you know, in the beginning of June, we actually took our forecast down to $94.50, and we're in the process of revising those numbers. So they will be probably about $4 lower than that. If you put a 13 multiple on that, you're kind of in the neighborhood of where we've been trading. Although we've been trading a lot of different neighborhoods over the course of the last 2 weeks,
right?
Where we're trading right now. So probably somewhere between $90 and $92 a share for this year. It's next year that's the real issue, and we have been looking at models that put us back at 80 in the high 80s next year.
Right. It's kind of interesting because we do have a lot of people who come on, or some who come on and say, these stocks have been beaten up a big time and that the valuations look low. David Tice, I just want to bring in David Tice again because he did talk with Matt earlier, and he did address that valuation standpoint. He's looking at those price to earnings valuations. So listen to what he had to say.
We have lots of problems in Europe. I still think China is a massive bubble, and now people are losing confidence at the U.S., and I believe earnings are going to disappoint, and therefore these PEs that people think are relatively cheap may not be as cheap as they look.
I got to say, Lincoln, it does feel kind of ugly. I don't know that it feels as bad as September or fall of 2008, but it does feel similar. You don't think, though, we're going to go back into recession, but could growth be low enough that's going to feel like a recession? So what if it's not statistically?
I think that picture you paint is exactly the kind of environment that we'll be in, not only for the next 2 quarters, but probably for the next 18 months. We have very difficult sort of path to navigate here between austerity, which we know sort of in the political environment will be faced with, and also trying to get our friends and fellow Americans and people really on a global basis back to work in the productive parts of society. So I think that David's concern and our concern has always been that these forward earnings expectations are far too elevated, but we do not see, simply because the emerging economies will continue to produce demand that will keep us out of a full-blown recession.
Lincoln, let me take you to Europe for a second and get your take on what's going on there. You said there's a problem with everybody waiting for the Fed to do something, but everybody's waiting for Europe to do something. Angela Merkel saying today that she doesn't want to do Euro bonds, but we're looking at possible legislation out of the EU Commission to force those on the continent. What do you think about the situation there? What's the solution?
So there is a structural issue that needs to be dealt with in the European scenario, and that is the recapitalization of the Spanish and Italian banks. And in the European situation, there is a structural issue that needs to be addressed, much like we did in the United States by issuing the TARP funds and recapitalizing our section of the financial system. That will have to be done in Europe. And as others have talked about over the course of the last 2 or 3 days, Germany's bitten a rock in a hard place here because they're darned if they do and darned if they don't. The euro falls apart, really, if they don't. And if they do, they are going to end up footing a substantial part of that bill. So recapitalization in the European financial system is a necessity. And once we get that structural sort of keystone in place, then we've got to go.
We got to go as well. Hey, Lincoln, thank you so much. Lincoln Ellis joining us. He's the managing director of the Lynn Group.